Welcome, everyone, to the Daniel Krug and Associates Wealth Management Review for June 25, 2020. Today's presentation is titled Bumps in the Road. My name is Rocky Istvan. I'm the Chief Compliance Officer and Associate Wealth Manager at Daniel Krug and Associates. Daniel Krug will be joining me. He is the CEO and Senior Wealth Manager at Daniel Krug and Associates, and we will be doing the presentation today. Just a reminder that this presentation is for informational and illustrative purposes only and should not be considered investment or tax advice. If you have questions specific to your situation, please call the office and we will set you up with a meeting and get you those answers. Today we're going to cover some of the major developments that has happened over the past week, an update on COVID-19, reopening and unemployment, the markets and investing. Dan's going to highlight a strategy that we use in the office, and again, we'll do Q&A at the end. A reminder of what wealth management means to us. There's basically 5 major components, things that we work on for our clients, and it all begins with the investment strategy. You've got to know what your investment plan looks like. It's got to be customized to your specific goals and needs. And most companies do this part of wealth management. Some do it better than others, but it's only one of the 5 strategies that we walk you through. The other things we do is in the area of advanced planning, where we get into wealth enhancement strategies, wealth transfer strategies, wealth protection strategies. And I would say about a third of our clients are charitably inclined, and we have many strategies that maximize the tax impact of and savings of charitable giving. So each one of those strategies is customized to your specific giving needs and wishes, and to minimize taxes. Today we're going to be focusing in on a wealth enhancement strategy, talking about Roth conversions, and that will be coming in just a little bit. So let's go on to the major developments for this week. We actually have some data that has come out from some major universities, MIT, Harvard, Berkeley, McKinsey, and we're going to present some of that data today. So that is new and kind of got some good information to give you. The rising case spreading indicates that states still need to adopt proven policies and protocols based on what we've learned. And again, a lot of that information is just coming out to reinforce some of the things we're doing, and we're going to touch on that. The reopening is continuing, with most states progressing without an undue rise in cases. So even though you're hearing a lot in the news, most states are not having issues, and we're going to cover that. Fatalities and hospitalizations continue to decline globally. That's really important to know because overseas, China, Europe, they started up before us, and they're continuing to progress and see declining numbers. So while they're opening up and operating, those numbers are continuing to go down. And then we're going to talk about the economic activity that is rebounding in not only the US, but Europe and Asia. And we believe that looking back at the data, because the economy has picked up, that they're actually going to call an end to this recession around the end of May, beginning of June timeframe. So from there, let me give you a little update on COVID over the last week and the information that we've received. First of all, with the numbers, most states continue to see a decline in hospitalizations versus a week ago. However, in saying that, we have seen an acceleration in Texas and Arizona. If you look at the chart, wherever the bars are going up above the 0 line, that means there's been an increase. Wherever they're going down, that is a decrease. So basically, Texas saw about 1,000 hospitalization increase last week. Arizona saw about 500. California, less than 200. Now, all those are numbers to be concerned about. If you look at it in relation to the tens of millions of populations of these states, the numbers are still very small. So the question is, Well, if hospitalizations are increasing, what's happening at the hospitals? And that's what this chart shows. Basically, from the beginning of tracking hospitalizations back in the beginning of or middle of April through last week, we see on the left side of this graph the capacity of available capacity at hospitals. So from 0 to 100%, the yellow line represents 30% capacity, which means, hey, we need to pay attention to those numbers. 50% capacity is a warning sign. And yet, when you look at the states, Arizona, California, North Carolina, South Carolina, and Texas, the only one that's significantly showing a trend up is Arizona. That has breached the 30% available capacity in their hospitals. Okay, so keep in mind, 70% of the capacity is still available. Okay, but it entered that caution area because it's an increase in a trend that we haven't quite seen in other places. So Arizona is an area of concern, and you're hearing this in the news, but understand it's not getting in the area of available capacity. Plus, also keep in mind that additional capacity contingency plans were put into place if we ever breached 100%. So this isn't counting any of that available capacity that we could go to, other facilities, other resources and things like that, that were actually planned out way back at the peak of this. So this is just current available hospital capacity, and things seem to be well in line, except for we got to watch what's going on in Arizona. We brought this in because Florida's been in the news a lot because there's been an acceleration in the positive test rate in Florida. Now understand that they have increased testing significantly in Florida, and whenever we increase testing, we're going to get more cases, right? Positive test results. But when we look at these two charts, what you see on the left chart is what's happened over the last week or two with the positive test rate. It has jumped up significantly, up from 4% up to a little over 10%, 11%, right? So there's been a huge increase in the positive test rate. However, if you put that in relationship to how many of those people have been hospitalized, that's the chart on the right. And basically what it's showing, while there was an increase over the last couple of weeks in hospitalizations, it's still nowhere near where Florida was a month ago. Okay, so what does that mean when the people that are testing positive is going up, but the hospitalizations are not increasing at the same rate? It means that people are fighting this disease off without major medical treatment. They're able to stay at home or whatever and get over the virus. So that's a good sign. More people that are being tested isn't equating to having to go to the hospital as a critical illness and be treated for it. So I think that's a pretty good thing to see happening. Now, this study just came out last week. This is a study by MIT, and what they did is they took the hypothesis of, is it possible to achieve safety results of lockdowns, of a complete lockdown, with a different or more targeted approach to the problem, okay? Because if you lock down, obviously there's no economy going on. It stagnates the economy, right? And so what the bars represent, starting on the left, is the first bar is a lengthy total lockdown, meaning this was the worst case, everything shuts down, and what's the cost of that to the economy? That's an $8 trillion cost to our economy. Well, our national annual GDP is only 22 billion or trillion, so that is over a third of our GDP gone for the year. The next bar over says, well, what if we just shut down? And again, this was a study with data to back this. What if we did a targeted or semi-shutdown? What's the cost of that? About 5.4 trillion in GDP. What about the next bar? This is what happens if you would do group distancing. Again, you would reduce the cost of this program, this virus, down to 3.6 trillion. The next bar is improved testing and isolation. Again, reducing the cost, okay, against the economy. What happens in the last bar, the 1.5 trillion cost, is if you combine group distancing with improved testing and isolation. Struggling with that word. So basically what it's saying is you can cut the cost in half by grouping this group distancing and improved testing and isolation measures put in place. And yet it's not nearly the cost of a total lockdown. But the most interesting part of this study is that everything resulted in a mortality rate of 0.20%. So what their original premise said is that if we did a total lockdown and it cost the economy 8 trillion, you would still have a 0.2% mortality rate versus all the way over to only a fraction of that cost by combining group distancing and improved testing and isolation. You still would only have a 0.2% mortality rate. So that is significant. All these strategies, and this is what MIT research is proving out, is that you can do these strategies that are less than a total lockdown and still get the results of the lowest mortality rate, which 0.2% is still high. It's double regular flu season, but significantly at a less cost to the economy moving forward. So very good information, very good research being done to help us figure out how in the future to deal with these situations. So what I'm going to do now is we're going to change gears. We're going to move over to reopening and unemployment. And Dan, CEO and Senior Wealth Manager, already is on the screen with us. So welcome, Dan, to our presentation today.
I just wanted to make a note, Rocky, that Kathy, your wife, this is for everybody out there. If you remember in the past presentations, Kathy kind of had him in a black box. So his background, all you can see is him. He was in this black box. Well, he graduated out of the black box. Now he's out in the barn. So that's where the barn pit's coming from. So hopefully someday he'll be allowed to come to the house and do it out of his house someday. So just a little thought there. All right, Rocky, I can go ahead and take over from here, and we'll get on to reopening and the numbers.
Okay, sounds good.
Okay, reopening and numbers. There is a lot of evidence out there now, as I'm going to kind of present here, that shows that we pretty much hit the bottom in the economy and are now moving outward. So this is a very, very, very good sign. This chart that we have up right now is the total U.S. freight carloads. In other words, you've got the trains and such that are transporting carloads worth of manufactured goods, and that freight number, as far as the number of carloads, bottomed out on 5/29 and is moving upward now. So that's a great sign. It means that we're actually starting to manufacture and get it on the rails and out to where they can finish the product. So very good sign there. Home builders, the National Association of Home Builders survey showed that we kind of bottomed out right around April and again are moving forward. In other words, you've got construction going at this real nice pace right now, moving up towards the ultimate goal of getting back where we were before. So again, home builders, it's bottomed out and moving forward. Auto sales. It's interesting with the auto sales. They bottomed out again in April and are moving forward. And I think there's a couple reasons for that. One, yes, we are manufacturing. People are getting out. But two, the automotive industry is really putting out some pretty nice incentives to buy cars right now. So I actually had a couple clients call up this week talking about how they're buying a car, 0 interest rate, deferring the payments out for a few months. So a lot of incentives if it is about time to replace your car and you're comfortable with doing it right now, might be a very advantageous time to do it. Manufacturing is picking up all in all. As you can see here, we've actually got 4 different surveys that we're taking. Prior to February, everything was moving along quite nicely from a manufacturing standpoint. Then obviously we hit February, it drops down. And again, in April, it looks like we bottomed out based on these surveys, and we're moving ahead. It's actually, we're moving ahead nicely. So we're about where we were prior to the crisis. And as long as we don't have any real spikes in the COVID outbreak or a second wave, it looks to me like this will continue moving this direction. And if you even look at things from more of a global standpoint, there is strong economic data that's showing that globally we're rebounding as well. And this shows a chart of the United States, France, China, and Germany. And you can see that China kind of fell down first, and that's that first V shape that you see there. And then you see the United States, France, and Germany. But what you can also see is that the Purchasing Managers Index for each one of these countries hit bottom and is now moving forward again and getting very close to where we were pre-crisis. So again, good news there. You know, when we're looking at this chart here, we've looked at this chart this last week and the week before, and what it talks about is the government spending relative to sending checks out to individuals in relationship with each individual's personal income. So in February and March, you see that the amount of income that was from a government transfer, in other words, checks coming in, was a bit lower than you're seeing in April. April, we saw a jump in the actual amount of money that most people have received for personal income. So that's their personal income in combination with the government checks that they're getting. And you see a rise overall about 11%. Now, you strip away the government transfers that are coming in, and you're seeing an income level drop of about 7%. So it is so important as we're moving forward that this economy keeps going the right direction, because as the economy picks up, the government can pull back on the checks. Or you could look at it conversely and say, as the government is pulling back on the checks that they're mailing out to people, the economy has got to pick back up to offset the losses in income. So it's something that we really need to focus on moving forward, getting these companies, the small businesses, the big businesses open and running, so we can keep everything hopping and keep this recovery moving the right direction. Now, I will tell you that the hiring has actually slowed a little bit from June 1st to June 19th. Didn't stop, and it didn't go backwards, and that's a plus, but it did slow down a little bit. So June, we were at looking at the hourly workers at pre versus now versus pre-crisis. We're down in June 1st, negative 29%. June 19th, we moved up a bit to 26%. So we are moving in the right direction. It just slowed down a little bit. And part of that, I believe, is effectively with the news really kind of hyping up what they were calling this major spike that's going on the COVID. I think people step back a little bit, but once they realize the numbers really aren't as bad as they were sounding, I think you'll start seeing the numbers and the the workers move in the right direction. So that brings us to markets and investing. So when we're looking at the speed dials again, from a credit standpoint, I've said this quite frequently, not a whole lot of movement there. It's in good shape. It's all green, so we're not going to spend a whole lot of time there. But I do want to talk a little bit about the default rates that are coming into play right now. So when we're looking at this chart, this shows a graph of non-investment grade defaults and the rates over time. And you can see in the financial crisis of 2008, 2009, that there was a 15% non-investment grade default rate, which was rather high, quite frankly. But that kind of went back down in 2010, and you always have this jostling going on within a chart like this when you're talking about defaults. But ultimately, when we got to this crisis, what we're projecting, because this is more of a lagger as far as what we're projecting here as far as the defaults go, we're projecting about a 12% default rate. Right now, we're at about a 6% default rate. And again, this is investment grade, non-investment grade default rates. So is that a very high number? Well, it's high, but it's not anything that our institutional money managers don't believe they can handle or weather through. Now, why is that? Well, because they're rather selective as to who they're bringing into the portfolio. So they are looking at the cream of the crop when they put these portfolios together. So they're projecting that the default rate within the portfolios would be much lower than the overall default rate. So that's a good thing for anybody out there wondering about that aspect of the investing. So let's move on to the equities market. Again, the fear indicators red, valuations are red. Overall financial conditions are moving forward, so that's good. We've looked at this chart many times, and ultimately the chart shows the price earnings ratio for the S&P 500, and this chart is still on the high side. We're sitting at 21.41 right now on the price earnings ratio of the S&P 500. So even with the bit of a dip we had, the number hasn't changed that much because the earnings just are not kicking in at this time. So that's an area, again, we'd like to see the numbers get down into the blue area, somewhere between 15, 14, 16, somewhere in that area, to put us in a much better position where the institutional money managers are ready to dip in. And by the way, that would be a good time for us to be able to jump in and start implementing our strategies. So this is something we're obviously working or looking at. So we'll just keep watching it as we move forward. So that takes us to where we are now. And you're looking at this chart, and what we're seeing here is a market that is starting to capitulate a little bit. They are showing a little bit of weakness at this point, and it's something that we're looking at. So when you're thinking about the COVID crisis, and you start seeing the fact that the news is really kind of portraying things in a less than good light, what you're finding is that the market's getting a little weak because of that. Now, as we were talking about last week, if we have that in combination with bad earnings, it could very well be the catalyst that moves us down the slide here and puts us in a position to actually start executing. We are looking for, and many of the institutional money managers are looking for, what they call a healthy correction. at this point, which would be anywhere from 10 to 15%, really up to 20%, but they're looking right now at about 10 to 15% correction. And that would actually put us in a position whereby it would get us in that blue zone where if we execute, the execution mark would be somewhere between 2,500 and 2,700 on the S&P 500. So we are watching that and we are anticipating. So we're ready to execute if we do hit those numbers. When you think about earnings, so there's good news and bad news with earnings out there. There is a significant drop expected for 2020. So effectively about 20% drop in the earnings on the S&P 500 as a whole. Again, big drop for 2020, but the silver lining is as we ramp back up again, we're looking at 2021 having about a 27% increase, which would put us slightly above where we were at 2019 levels. And I think they tend to be a little bit conservative on these numbers, but we've got to wait and see how it actually plays out. But I would imagine that again in 2021, it's going to be a good year for us overall in the market. If you think about where the earnings took its biggest toll, U.S. small cap stocks were the ones that got hit the hardest from an earnings standpoint. So their earnings dropped about 39%. Then you kind of go over to emerging markets in excluding Asia, that's about 24%. The two best would be emerging markets, Asia and U.S. large cap being the healthiest of the sick, I guess if you would put it that way. But we'll be watching that. We expected it to come in this direction. We'll kind of see how it actually plays out in next earnings season, which is right around the corner, which should really give us another chart like this to give us an update. And as you get closer to the recovery in this data that we need, you'll see the numbers kind of get very more targeted as to what we're estimating will transpire as we move forward. So again, watching the data. So all in all, the markets are really moving forward. The economy is moving forward. So there's a lot of positive things going on out there. Certainly, we do have to get everybody back to work. I've talked to a lot of business owners. Many of them say, well, you know what, we're trying to get everybody back to work, but they're sitting home collecting that check. So they're kind of refusing coming in yet. The checks will stop. And I'm pretty sure those people waiting at home will probably change their tune at that point, which could get us a relatively big influx on the workers coming back to work. So a lot of positive things there. So let's go on to the opportunities. Again, we talked about the fact that we're going to highlight some of the strategies, a strategy every week. So let's go ahead and look at that. Rocky already told you we're talking about the investment strategy and wealth enhancement. We've got 5 strategies that we're working on and have actively structured for our clients at this time. Today, we're going to look at Roth conversions. So the question, does converting really make sense? And I'm here to prove to you I believe that it does. There are multiple benefits to a Roth conversion strategy beyond what we're talking about doing during this crisis right now. But let's talk about those real briefly. First of all, if you do a Roth conversion, you really stack the deck in your favor. In other words, hey, if taxes never change, it's no harm, no foul. You did the conversion. It didn't really hurt you from a tax standpoint. However, if taxes do go up, like most of us believe it's going to, then your delta between doing the conversion and not doing the conversion it just, the window gets bigger and bigger on your favor. So stacking the deck makes a whole lot of sense. It's one of those things, better to be prepared for an opportunity and not have it come than have the opportunity come and not be prepared, right? Well, we want to be prepared. The next one is control your tax brackets and you control your income tax. What do we mean by that? Well, if I've got a Roth account and I need income coming in, I can actually regulate the taxable income by bringing in additional income from the Roth if needed. That helps me control the tax bracket. So that keeps my taxes lower. The next one, asset location investing. I'm not talking about asset allocation. We're talking about asset location. And that is where we literally target the rate of return based on the tax status of your account. So if you have an IRA, that's going to be a little bit more conservative. If you have a Roth, that's going to be more aggressive. Again, we want the tax-free money to grow faster. So asset location, studies have been done that says that if you do this properly, you will end up with about a 1% increased net rate of return over time, annualized, for your investment. So that is a huge one, but you can't do it if you don't have a Roth. So it's important to make sure we get that implemented. The next one, who here absolutely wants to be forced to take your required minimum distribution? Well, I know not a lot of clients don't. They don't need it, but they're forced to take it and subsequently get taxed. Well, the less you have in your IRA means the less RMD. So the conversion actually helps you control your taxes there as well. Next one. Now, this is something that nobody seems to talk about, but it is a huge benefit for clients. Everybody talks about fees, but you know, if you don't look at converting money, you're not actually utilizing every method to reduce your fees down. What do I mean by that? Well, if I have $1 million IRA, I know that all of that is not my money. Part of it belongs to Uncle Sam because he hasn't taken his tax out yet. So even if you were at a 20% tax bracket, 20% of that money is being feed by the advisor because the whole account is being feed. Now, I'm not advocating lowering my fees, but it's a byproduct of this strategy for our clients. So when you're looking at it, if you remove Uncle Sam's taxes, you're not trying to grow his money anymore, which also means you're not paying your fee on that money. It reduces the dollar amount that you pay on an annual basis, and that's a good thing as well. So if we go back to this chart and we look at the presentation I'm going to show you on the Roth conversion and how that can benefit you, we already know that they're looking at a 10 to 15% correction in the market. We're going to look at the number 12.5% as the correction number when we do our calculations here. So let's move on. Here's how the story goes. We've got John here. John has an IRA that grew to $1 million. And this was prior to the crisis. So he's feeling pretty good about things. But then we have the crisis hit us. And, you know, the market drops down, his account goes down to 750. There's a lot of volatility going on. You're starting to see the recovery like we're doing right now. So it goes down 7 to 750, then retrace or comes back up to 885. And he's thinking to himself, well, we're going to have a next downturn. So why don't I do a Roth conversion? And in this case, he's going to do that Roth conversion for $100,000. So as we move forward, here's what comes to play. Let's say the market does retrace that 12.5%. Now, John's looking at it and saying, okay, I'm going to convert that 100,000 over to a Roth. Now, I have to make this note. When you convert on a downturn, you're effectively converting a higher percentage of that IRA to a Roth. In other words, if you've got $1 million and you convert 100,000, you're going to convert 10% of that account. But if the market drops down to the 769 mark and you convert 100,000, you're actually converting 13% of the money. So it's a much larger percentage, which means you don't have to convert as much down the road. So let's keep moving here. So we do the conversion, the market comes back to even, which by the way, would probably take about a 30% return back to get us back to normal. So all the accounts at that point have moved forward getting a return. So your IRA went up 30% and so did your Roth IRA. So your Roth was 100,000, now it's 130. So that's important. Why is it important? Well, let's look at the numbers. When you think about it, all the money eventually is going to be taxed. Now, I'm giving you some relatively conservative tax numbers here. So in John's case, his federal tax rate is 22%. State tax rate in Michigan is 4.2. So this gives John 26.2% total tax obligation. So what is 26.2% of $1 million? $262,000 in taxes. Again, that's Uncle Sam's money, the 262. So let's compare that to actually doing the conversion of the account, $100,000, and let's see how the numbers play out here. So you still have your IRA, which is still fully taxable, 26.2%. But your Roth account doesn't have a tax on it. So there is no tax obligation on that money or the money that grew in there. So the total tax obligation after the strategy and the market getting back to where it was is $227,940. So just about $228,000. You look at prior to this crisis, and he was paying $262,000 on the $1 million. So that's a pretty good savings of $34,000 in taxes by doing this strategy while the market is down. You know, any time's a good time to do a Roth conversion, but there are opportunities like this that come about that actually enhance that Roth conversion. So good numbers, great strategy. We just got to allow that, or hope the market comes back down again to get that execution point. And we will keep you apprised of what's going on relative to that as the market moves forward. So that kind of brings us to what are the current updates on the strategies we're already trying to implement. Well, you know, while the market was up, we're paying the taxes on the pre-crisis Roth conversions, and also we've been paying any kind of life premiums that were due that we did not pay during this crisis when the market was down. So that's all being implemented. If you were in that window where we were working on those, you probably got an email or a phone call from our office. If you haven't gotten that yet, you will as we execute these programs. So that being said, that kind of brings us to questions and answers. So I'm going to bring Rocky back on. Rocky, you want to come on?
Sure. I am here. So good presentation. Like the example.
Well, thank you.
I'm looking at chat and see if we've got any questions. One question that kind of I noted in here is valuations are high, Dan. Are the money managers, though, buying or selling during this time? What are they doing?
You know, that is a great question. It depends on the money manager. However, what we're seeing is many of them still have some cash on the sideline that they're waiting to deploy. If we have a downturn and they believe the downturn is momentary, they probably won't sell anything off they have right now, because what they have in their portfolios are strong companies that they feel long term will get the returns they need. And because this downturn could be, again, momentary, they don't want to make any changes on it. However, having that money on the sideline is the money that they would deploy at the next downturn to just boost the returns that they would have in their portfolios.
Yeah, I remember I was talking a couple days ago with the money managers, and they were talking also about they are finding some opportunities still. It's very selective, but not everything is overvalued. What's generally driving this market is the tech stocks, anything related to internet-based, things like that. But there's many solid companies out there that are going to be in business that they're looking for those opportunities. So there is maybe a little bit buying going on, but you're right. They're holding cash for this market to drop and increase their positions on quality companies. So,
yeah, that was actually a very good question.
Okay, so I don't see anything else out there, Dan. Is there anything else you would like to add?
Well, it's just interesting. I'm going to bounce back to the information you gave on the COVID virus, and I'm always looking into it, researching the numbers. And one thing that struck me when I was on the CDC site is when I started comparing the mortality rates with other things that are going on, car accidents, the suicides, things like that. What I found was kind of interesting, because there was something that was missing in the COVID numbers that was in all the other statistics, and that is this. When they report the COVID numbers, they're reporting how many people actually have the virus or had it, and how many deaths came out of it. What's conspicuously absent is that they're not comparing the deaths to the population, and that's how we do most of our comparisons when we're talking about mortality. So what I find very strange is that when you actually do the calculation, the U.S. population to the number that have passed away, that number shrinks to a number that I think if everybody saw it, they'd say, well, that's not as bad as I thought it was based on what I'm seeing. Again, like everybody says, any death is a bad death if it can be prevented. But the reality is, and this is sad, but it's part of life. We die someday. But at the end of the day, what I would like to see is the mortality numbers based on population out there, because it tells a story. And what we don't want to do is frighten the people so much that they feel they can't go out because the numbers look so bad. And again, I believe that's just because we're comparing it only mortality to the number of people that actually received or caught the virus. So just a side note there. But above and beyond that, I've got some good news. We're looking at the remodel. The remodel is still moving along, a lot slower than I wanted it to be. However, it is moving along. We've got all the drywall up, and the painters are in there now. Next week, they're going to be working on some floor projects. So that's really nice. The week after that, we'll finish up painting and then get into carpet, and we're getting to the home stretch here. So that's kind of an exciting thing that's coming down the road here. And we're all looking forward to getting back in the office, and we're looking forward to seeing you guys back there as well.
Yeah. And one of the questions is, are we going to be able to meet face to face? I would say that, we're going to be doing what accommodates you, basically. That yes, we will create an environment that we can have the face to face, We will be following social distancing rules. But if somebody's uncomfortable with that, don't worry about it. We can talk over the phone. We can do these meetings one-on-one, just like we're doing these webinars, whatever you're comfortable with. But yes, the goal is to be able to have a meeting face-to-face with clients in the office when it's appropriate to do so.
Yeah. And all of our clients this week will be receiving an email. It's really a survey to let us know. It's just 5 questions to let us know how you feel in the different areas. You know, when it comes to having the events, you know, how comfortable are you with going to an event like that? If it's 100 people, if it's 50 people, if it's at the office, questions like that. Again, very quick, you'll be able to mark it, and we'll get the survey back, and it'll allow us to understand where our clients are when it comes to coming into the office and having appointments, as well as having the different events, which allows all of us to really kind of get together and not be stuck in these rooms all the time. So we are really looking forward to seeing everybody when the opportunity opens up, and we're chomping at the bit right now. At least I am. I've just got to go nuts in this house.
Yeah, there's a couple more questions, but we are running out of time. Scott, we will contact you and follow up with your question. And anybody else that's got a question, we will follow up directly with you. So we've got to get going here. What I'm going to do is keep us moving forward. So we appreciate you guys being on the webinar today. And we want to remind you there's no need to worry. So you take care of your family.
And once you take care of your family, we're here to take care of you. We're ready for 2020 and beyond. So, you know, we're going to sign off at this point, but know this: we are watching your money. We are watching the strategies, the markets, the economy, and we will be here to help protect what you've worked so hard for. So that being said, I'm going to sign off. So you guys all have a good day.
Okay, everybody have a good day. Goodbye now.